What if I told you that there are listed stocks in Tanzania that can pay you annually and steadily? Hi, my name is Victor Busara, a certified financial educator by the Bank of Tanzania. I am here to give you a game-changing strategy on how you can analyze stocks so that you can make consistent returns. And this is called value investing. So, as I previously said, that the strategy is called value investing. The author of this strategy, or the initiator, the two main initiators of this strategy are Warren Buffett and Charlie Munger. They base their philosophy of investing on analyzing the value of the company before buying the stock. So what we want to see in a stock is its price being low while the value is high. Do not worry if you don't understand what's value, how do you calculate the value of the stock. We're going to discuss right here in this video. So before we proceed, to analyze a stock, you need to have a report called financial statement. Financial statement is a compilation of the company's profitability, the company's assets and liabilities, plus the cash flow statement. Very simple. It shows whether a company is making profits, it shows the net assets of the business, and it shows how much cash the business has. We always want to invest in a stock whose share value is high while the price is low. I quote Warren Buffett once said, "Price is what you pay, while value is what you get." As you go through the financial statements, you'll need to understand one key concept called ratio analysis. In ratio analysis, we look at specific items from the financial statements, and we use those items to make calculations that will help us reach a financial conclusion of whether we should invest in this stock or not. If you're together with me till right now, then you're on the right side. The three most important ratios that I use in analyzing companies before I make a decision to buy a stock or whether not to buy or to sell a stock are as follows. The first one being the most important. The first ratio that I use is called the price to book value ratio. This is the simplest ratio. You basically compare the share price that you see in the stock markets, in this context, the Dar es Salaam stock markets, the Dar es Salaam Stock Exchange. I compare that price with the book value per share. Now, how do you calculate the value per share? Very easy. Don't worry. If this concept looks very hard, stick till the end and you will understand what it means. How do you find the book value per share? You open the financial statements. You go to the place or to the item written shareholders' equity. That is the net worth or the net assets of the business. That is the book value of the business. You divide the figure that you see there by the total number of shares that the company has. And by therefore doing, you will get the net asset value per share or the book value per share or the intrinsic value per share. You will therefore figure out what every stock is worth. Then you compare it with the price. So the ratio is price to book value. So you take the book value, you take the share price as the numerator, you divide it by the book value per share, and you get the PB ratio. If the PB ratio is less than 5, that's a good opportunity to invest. Buy the stock, ask questions later. If the price to book value ratio is from 5 to 15, consider buying because there's some conditions, there's some circumstances, especially in service-based businesses where the book value might not necessarily be higher than the share price because the business does not have tangible assets. Unlike in manufacturing where the business has tangible goods. and stocks and inventories. But in service-based business, that ratio might not be very applicable. If this ratio is from 15 going upwards, then probably it's a good opportunity to sell that share if you have it. That is the first ratio, and that's the most important ratio. Why? Because you have to maximize what the value that you're receiving in comparison to the price that you're paying for the value. And this cuts across not only in financial markets, but even in the real world, in relationships, in transactions, in deals. You have to make sure that whoever you're surrounding yourself with offers more value to you compared to the price it takes to stay with them or keep them. And also, as an individual, you have to maximize the value that you're offering to your cycle so that you may keep on being relevant. The second ratio that I use to analyze the stock of a company so that I can make a decision whether to invest in that stock or not is the PE ratio. Now, this was the hardest ratio for me to understand, but I'm going to make it very easy for you to get it. The price to earnings ratio is basically a comparison of the price of the stock, the current market price of the stock in the stock market exchange, in comparison to the earnings per share of that company. So, how do you come about this ratio? You have to first get the earnings per share, what each share is earning. How do you get that? You get to the income statement, you go to the item written profits after tax, you highlight that item, that number, then make sure that you divide that number by the total number of shares. Therefore, the numerator will be the net profit after tax, the denominator will be total number of shares. You get the earning per each share. Then you go and compare it with the price. Now, I will tell you how it works. When you get the price is your numerator and your earning per share as the denominator, if the outcome of that division is less than 5, that means that share is cheaply priced. You buy it. Why? Because it is less expensive to buy it. If the PE ratio or the number that you get or the outcome that you get after dividing price and earnings is greater than 10, then probably that share is overpriced. That means if you're holding it, it's a good opportunity for you to consider to sell that stock. The more technical meaning of PE ratio, it is basically the number of years that it will take the company to buy back all the shares that it has issued using its net profits after tax. So, if you want to see that the company has high earnings, it means that it should take less years for that company to buy back all its shares. Why? Because it has high earnings. If I have high earning, I can spend less time to buy back the shares that I've issued. But if it takes me a longer time or a much larger number of years, it means I am not generating high earnings enough. So in simple language, in basic terms, it is basically the number of years that it will take a company to buy back all its stocks using the net profit after tax. So, if the PE ratio is low, you make a decision to buy the stock. If the PE ratio is high, you make a consideration to sell the stock or wait until the PE ratio is low. The third ratio is a calculated ratio already that you will find it in the financial statement. That is the return on equity. However, if you won't find it, there is still an opportunity to calculate it. It is the return on equity. This ratio basically shows us how efficient is the management in using shareholders' funds in generation of profits. What do we want to see in the return on equity. We want to see a return on equity that has a greater rate of return than the 10 years treasury bond and the annual inflation rates. For instance, in Tanzania, the inflation rate ranges around 3.4 to 3.5%, and the return on 10 years treasury bond ranges from 12 to 14.5%. So, what am I looking for in a company's return on equity? I want to see a return on equity that is greater than the inflation rates, the 3.5%, and the 10 years treasury bond yield. This is the simplest ratio. Moving to the holy grail, this is the ratio that every investor looks at. This is the ratio that changes everything. So you better pay attention to this last key ratio. This last ratio is the dividend yield. However, this might not necessarily be the case because good companies and good opportunities are spotted when a wonderful company doing a wonderful business is in a turbulent period whereby it might not necessarily be making high profits, therefore not ensuring very high yields. However, as an investor, you have to make sure that the company that you're putting money in, at least there is some prospect of getting dividends in the future. Now, this dividend yield is the simplest ratio, and it needs you to be very attentive so that you make high decisions, so that you make the best decisions before you buy a stock. What is dividend yield? This is basically the rate of return of your investment or the return on your investment. You get the yield by dividing the dividend per share that is usually announced by the board of directors of that company, and it is later passed by the shareholders. You take the dividend per share that is declared by the board of directors, you divide it by the market price at which you are expecting to buy or at which you already bought that stock. After dividing the two, you multiply it by 100%. Therefore, the answer will be in percentage form. What do we look for in dividend yield? We want a dividend yield that is at least higher than the inflation rate in the first year. Then in the consequent years, we want to see the dividend yield creeping steadily, becoming higher than the 2-year yield bond, and the 5-year yield bond, and the 10-year yield bond. This gives us higher propensity to invest in that stock. Why? Because it has higher rate of return than the risk-free. Therefore, if you're keen and you're sure that you want to be successful in your investing journey, you have to make sure that you have mastered the art of understanding ratio analysis. For more information and more practices concerning analyzing ratios from an investor's perspective, I urge you to buy a book that is written by Mr. Busara that clearly extrapolates from page 1 to page 28 on ratio analysis, and from henceforth, from page 30, it gives us case studies whereby several companies have been analyzed as examples so that it may sharpen your skills. That book is called How to Read and to Analyze Financial Statements by Busara. And this is how it looks like. This is actually the best book that I've ever read concerning ratio analysis, because it actually changed the way I saw and I analyzed companies. I used to read this book when I was in Form 5, whereby it made it so easy for me to see and spot and grab investment opportunities. By then, CRDB used to be 100 shillings. Nickel used to be 150 shillings. And NMB share price used to be 2,300 shillings. But today, these companies have reported tremendous capital gains. How did I spot these opportunities? by sharpening my knowledge when it came to ratio analysis and value investing. This is the last word that I'm going to leave to my fellow youths, to foreign investors that are aspiring to invest in Tanzania. Here's what I can say. Don't wait to buy the stocks listed in the Dar es Salaam Stock Exchange, but rather buy and wait and see how the Dar es Salaam Stock Exchange can make you very rich if you give it a long-term perspective. Thank you so very much. If you need further clarification, further examples, more demonstrations on companies that you wish that I analyze and I give you my expertise advice on whether you should invest in them or wait, kindly comment below so that we may interact, we may share knowledge and experience, so that at the end of the day, everybody can maximize their wealth created. What is the last take that I can leave to you? What is the call of action? If you're a foreign investor, if you're a domestic investor, if you're a youth, you're a company, you're a microfinance, you're a business, you're a businessman, a businesswoman, here's what I can say. Don't wait to buy a stock given the opportunities in the Dar es Salaam Stock Exchange, but rather buy the stock and wait with a long-term perspective, and surely the Dar es Salaam Stock Exchange may make you so much wealth in the long run. Thank you very much.